Now we are going to discuss Chapter 4, Elimination of Unrealized Profit on Intercompany Sales of Inventory. So, just like the other 3 chapters, we have 102 slides from this chapter. So, I hope we can finish for the number of slides. Okay, so we have profit. In other words, if you have sales between the parent and the subsidiary, whatever profit between the two parties should be treated accordingly. So we have now the elimination of unrealized profit on intercompany sales of inventory. Introduction. Affiliated companies may make intercompany sales of inventory or other assets. The term affiliated group is used to refer to a parent and all subsidiaries for which consolidated financial statements are prepared. Alternatively, this group may be referred to as the economic entity or as the consolidated entity. Sales from a parent company to one or more of its subsidiaries are referred to as downstream sales. Sales from subsidiaries to the parent company are referred to as upstream sales. Sales from one subsidiary to another subsidiary are referred to as horizontal sales. So this time we have the term downstream sales, that's from a parent to one or more of its subsidiaries. Then we have upstream sales from subsidiaries to the parent. And horizontal, if you have from one subsidiary to another subsidiary. Now take note of these terms. Ordinarily, the selling affiliate will record a profit or loss on such sales. From the point of view of the consolidated entity, however, such profit or loss should not be reported until the inventory or other assets acquired by the purchasing affiliate have been used during the course of operations or sold to parties outside the affiliated group or the third parties. Profit or loss that has not been realized from the point of view of the consolidated entity through subsequent sales to third parties is defined as unrealized intercompany profit or loss and must be eliminated in the preparation of consolidated financial statements. Now, I'll read again the last sentence. Profit or loss that has not been realized from the point of view of the consolidated entity through subsequent sales to third parties is defined as unrealized intercompany profit or loss and must be eliminated in the preparation of consolidated financial statements. So in other words, we will involve elimination entries. Okay, so effects of intercompany sales of merchandise on the determination of consolidated balances. The work paper procedures illustrated in this chapter are designed to accomplish the following financial reporting objectives in the consolidated financial statements. Consolidated sales include only sales to parties outside the affiliated group. So we have now your consolidated sales, parties outside the affiliated group. So we understand affiliated group or affiliated companies. Consolidated cost of sales includes only the cost to the affiliated group of goods that have been sold to parties outside the affiliated group. Consolidated inventory on the balance sheet is recorded at a value equal to its cost to the affiliated group. Stated in another way, the objective of eliminating the effects of intercompany sales of merchandise is to present consolidated balances for sales, cost of sales, and inventory as if the intercompany sale had never occurred. As a result, the recognition of income or loss on the intercompany transaction, including its allocation between the controlling and non-controlling interests, is deferred until the profit or loss is confirmed by sale of the merchandise to non-affiliates or to outsiders. Determination of consolidated sales, cost of sales, and inventory balances. Recall that the cost of sales is computed as beginning inventory. We add purchases at net. We have the cost of goods available for sale. Then we deduct the ending inventory and we have cost of sales. Now, this is the process if we are referring only to a merchandising concern. Depending upon the accounting system used, a given company may have a single account in its general ledger entitled cost of sales or cost of goods sold and a single line on its work paper, or alternatively, separate accounts for the various components. In this chapter, we assume that the trial balance lists each component separately and we present the work paper entries accordingly. Using this approach, the cost of sales line on the income statement is replaced with lines for beginning inventory, income statement, purchases, ending inventory, income statement, and cost of sales or cost of goods sold. Note that under this assumption, ending inventory is found in the income statement that requires an entry distinct from the balance sheet account inventory. Now, the account ending inventory in the income statement has a normal credit balance because it is subtracted in computing cost of sales. Those items in parentheses are entries that might be replaced by the use of a single account, cost of sales. Now we have the illustration about those downstream sales, so meaning from parent to subsidiary. Elimination of intercompany sale of inventory, unrealized profit, all inventory, no unrealized profit, meaning all inventory sold to third parties, cost model or the equity method. The basic work paper eliminating entries required because of intercompany sales of merchandise are illustrated using the following simplifying assumptions. P company sells all goods it buys or manufactures to its wholly owned subsidiary S at 125% of cost. So meaning there is a markup equal to 25%. Now the parent is P and the subsidiary S. During the first year of this arrangement, goods that cost P Company 100,000 are sold to S Company for 125,000 or a downstream sale. During this same year, S Company sold all the goods purchased by it from P Company to third parties for 135,000. So we have now the data, the work paper entry, and the year of the sale. To eliminate intercompany sales and purchases of merchandise takes the following form. So take note, the very important transactions. One, again, P Company sells all the goods it buys or manufactures to its wholly owned subsidiary S at 125% of cost. During the first year of this arrangement, goods that cost P Company 100,000 are sold to S Company for 125,000 or a downstream sale. During the same year, S Company sold all the goods purchased by it from P Company to third parties for 130,000. 5,000. So we have now sale from S to third parties. So we have now the work paper entry in the year of sale to eliminate intercompany sales and purchases of merchandise. So we have now the entry for elimination purposes, debit to sales, 125,000 and credit to purchases or cost of sales to eliminate intercompany sales and purchases. Now remember, it's P Company recording sales for 125,000 and it's S Company recording purchases for 125,000. So you are now eliminating with this analysis. We debit initially in the books of P Company, debit to accounts receivable, and credit to sales. Now, eventually, that debit to accounts receivable or cash, and we credit to sales. Now, in the books of S Company, debit to purchases and credit to accounts payable. Now, incidentally, if S Company still owes P Company 40,000, now this is the assumption. The work paper entry would be as follows. Now, we have S Company to debit. Here, the debit is accounts payable S Company 40,000 and credit accounts receivable P Company for 40,000. Now to eliminate intercompany payable and receivable. We are now debiting to accounts payable for S Company 40,000 and accounts receivable of P Company for 40,000. Okay, so in other words, we have the elimination entries in order to show that several of these accounts will be eliminated because P and S are affiliated. Now, the cost model and the equity method, we have now the partial consolidated statements, work paper, elimination of intercompany sale of inventory, no unrealized profit, meaning all inventories are sold to third parties. Now, in the income statement of S Company, now the credit of 125,000. However, in the consolidated balances, it's already 135,000. As company sales is now eliminated, but there is sales of 135,000 to third parties. In other words, there is a markup of 10,000. Then the cost of sales initially is 100,000, but the charge of P company is 125,000. So we now eliminate by crediting cost of sales 125,000 and debiting sales by 125,000. So the remaining account balances sales of 135,000 and cost of sales of 100,000. So we have now the amount of gross profit totaling 35,000. Now that's the real profit, though the profit between the parent and the subsidiary is only 25,000. Now this time it becomes 35,000 because of the sale made to third parties. So there is an additional markup equal to 10,000. So we have now the percentages to be considered. If we consider sales at 100%, so the gross profit is 35 over 135. It's 25.925 or rounded off to 93. Now that's your gross profit rate, and so the cost of sales rate is 74.07%. Now, in the income statement, elimination entry is made for the purpose of eliminating the intercompany accounts, including sales and cost of sales. No unrealized intercompany profit exists since all goods sold by P company to S company have been resold to third parties. That's why there is a markup from S company to the third parties. Again, in the amount of additional markup of 10,000. Initially from P, it was only 25,000. So meaning S had another overprice by 10,000. After the elimination of intercompany sales, consolidated sales of 135,000 equals the amount of sales by the affiliated group S company to third parties as indicated by the arrow above. So we have now the arrow pointing to the consolidated balance for sales in the amount of 135,000. So we have now the consolidated cost of sales of 100,000 equals the cost to affiliated companies, Group P, of purchasing, manufacturing the goods sold. So it's purchases if you have merchandising concern, or you may have it as cost of goods manufactured, and finally still cost of goods sold for manufacturing concern. The gross profit percentage should be 25.93%, dividing 35 by 135. Failure to eliminate the intercompany sales would show the gross percentage as only 13.46. So if you fail to eliminate the intercompany sales, meaning you do not eliminate 125,000, so the total will be 260,000. Since both sales and cost of sales would be overstated by the same amounts, consolidated net income is not affected by the failure to eliminate intercompany sales. Failure to eliminate intercompany sales would result in an overstatement of sales and cost of sales in the consolidated financial statements. If the intercompany sales were not eliminated in that case, if the intercompany sales were not eliminated, so in both sales and cost of sales would be overstated by the same amounts. Consolidated net income is not affected by the failure to eliminate intercompany sales. Failure to eliminate intercompany sales would result in an overstatement of sales and of cost of sales in the consolidated financial statements. So that's if you fail to eliminate this intercompany accounts. Now we have illustration for 2 under the cost model. Elimination of downstream intercompany sale of inventory, unrealized profit in ending inventory. Only 60% of the inventory is sold to third parties. So in other words, not all the purchases made by the subsidiary from the parent were sold to third parties. So meaning there is still an inventory in. Assume now that S company sells 60% of the goods purchased from P company to third parties at 81,000. So take note, no? You have the amounts, 100,000 cost 125,000. That's your sales price to the subsidiary company S. And the sales to third parties amounting to 81,000. So you have now, if you have 125,000, 60% of it will only be 75,000, and the amount of sales to third parties was 81,000 prior to the end of the current year. Sales, cost of sales, and inventory balances reported by each of the affiliated companies are presented in figure 4-2. Year 1, eliminating entries for downstream sales. Entry 1, to eliminate sales and purchases, is the same as explained before. However, intercompany profit in the amount of 10,000, multiply 25,000 by 40%, resides in the ending inventory balance of S company. So in the ending inventory balance of S company. So that's now for 25,000 multiplied by 40%. This profit has not yet been realized by consolidated entity through sales to outsiders or third parties. So we have now entry 1 to eliminate sales and purchases is the same as explained before. Now, when at the end of the accounting period, some of the merchandise remains in the inventory of the purchasing affiliate, the intercompany profits recognized thereon must be excluded from the consolidated net income and from the inventory balance in the consolidated balance sheet. The work paper entry to accomplish this elimination and to reduce inventory on both the income statement and the balance sheet is as follows. So we have now to debit ending inventory in the income statement for cost of sales, the amount of 10,000. We have now the computations above, and then we credit to inventory balance sheet to defer the unrealized profit in ending inventory until it is sold to outsiders. So we have the 25,000 multiplied by 40%, which is the gross profit rate. So, as stated, only 60% of the goods purchased from P company to third parties were sold to third parties. In other words, there's a remainder equal to 40%. So we now debit to ending inventory income statement for 10,000 and credit inventory balance sheet for 10,000. The entry eliminating intercompany sales, entry 1, implicitly assumes that there is no unrealized intercompany profit. Accordingly, either entry 1 must be adjusted or entry 2 must be made to remove the unrealized intercompany profit from the ending inventory and to reduce the excessive credit to cost of sales. To reflect the above eliminating entries in the okay let me go back to reflect the above eliminating entries in the income statement and of course in the balance sheet. Now we have this illustration. In the cost model, partial consolidated statements, work paper, elimination of downstream intercompany sale of inventory, unrealized profit in ending inventory, 60% inventory sold to third parties, first year of intercompany sales. So we have now in the books of P company, we have sales of 125,000, whereas in the books of S company, it's only 81,000. Then the cost of sales of 100,000, and we have now 60% considered as sold. So, if we have 125,000 multiplied by 60%, that gives 75,000. So, in the sales to third parties, there is a profit of 6,000 considering the selling price of 81,000. And in the balance sheet, the inventory remains at 50,000. That's 40% of 125,000. So we have the inventory remaining balance equal to 40%. So it's 50,000. Now we go to the elimination entries, debit and credit entries. We now debit to sales for 125,000, and we have credit here 125,000 for the amount of cost of sales. We have 100,000 for P company, and then we have a debit of 10,000. So that makes the amount of Actually, 100,000 minus 60,000, you only have the inventory 40% or 40,000. Then the cost of sales, considering 125,000, 60% is 75,000. There is an added profit in the amount of 6,000. We debit the amount of 10,000, and we credit cost of sales initially for 125,000, and likewise we have a credit to inventory for 10,000. So the remainder of inventory now is 50,000 minus 10,000 or 40,000. That's now in the inventory balance in the balance sheet, where you have the amount of the ending inventory equal to 40,000 after the profit of 10,000 is deducted. Now, to eliminate intercompany sales, that's entry number 1, debit sales of the parent company, and we have to credit sales of here. We have to credit cost of sales of the subsidiary company. Then entry number 2 is to eliminate intercompany profit in ending inventory amounting to 10,000. So we have now to debit. Here the entry is in line with number 2. We have to debit cost of sales and credit inventory for 10,000. As a practical matter, two entries are conventionally prepared as shown in figure 2. In either case, after adjustment, consolidated sales of 81,000 equals the amount of sales of the affiliated group to third parties. Consolidated cost of sales of 60,000 equals the cost to the affiliated group of the goods sold, which is 100,000 multiplied by 60%. The consolidated inventory balance equal to 40,000 equals the cost to the affiliated group of the goods held by S company at the end of the year. That's 100,000 only. That's the original cost to the parent, and we multiply by 40%. Now, you will notice that in the consolidated balances, we only show sales of 81,000, only sales to third parties. We have eliminated the intercompany sales. If we have P company sales as a credit, and then we debit 125,000. And the difference of 21,000 between sales and the adjusted cost of sales, that's equal to 60% of 100,000 is equal to 60,000. So we have now the gross profit of 21,000. Now, the above entries for intercompany sales and unrealized profit in ending inventory are the same regardless of whether the parent uses the cost model or equity method. However, as shown next, second year, the entries for intercompany profit in beginning inventory differ slightly. Now we have year 2 eliminating entries, still in connection with downstream sales. In figure 4-3, still with the cost model, elimination of downstream intercompany sale of inventory, unrealized profit in ending inventory, second year of intercompany sales. Assume now that in the next period, P company sells merchandise to S company in the amount of 250,000, the cost of 200,000, and S company sells all its beginning inventory. That's 50,000 cost to S, though in the consolidated entity it's only 40,000, or that's the cost to the parent. And one half of its current purchases from P company, 125,000 cost to S, 100,000 cost to consolidated entity to third parties for 202,500. Sales cost of sales and inventory balances reported by the affiliated companies are presented in Figure 4.3. This illustration assumes that cost model is used. So we have now the cost model, partial consolidated statements, work paper, elimination of downstream intercompany sale of inventory, unrealized profit in ending inventory, second year of intercompany sales. So we have now your second year income statement. Now P company sold 250,000 to S company. So and S company now sells 202,500 to third parties. So we have now the cost of sales equal to 200,000, and we have the sales of S company equivalent only to 50%. So now 202,500 is extended to the consolidated balances. And for the elimination entries, we have entry number 1, debiting sales and crediting sales of the subsidiary. Here we debit sales of the parent. In number 1, we have the credit as well of 250,000. In entry number 2, we have the debit of 25,000 to cost of sales. Entry number 3 is debit to the beginning retained earnings for P company, the amount of 10,000, and credit cost of sales for 10,000. So we now extend after elimination. We have eliminated 250,000. We are now extending 202,500, and the cost of sales figure in the amount of 140,000. So we have now the gross profit for P. It's 50,000. For S, it's equal to 27,500. And so the difference of 62,500 in the consolidated balances column. Then for the beginning retained earnings of P company, we are now debiting 10,000. And for the inventory is 125,000, though we have credit of 25,000, and the consolidated balance of 100,000. Now with these explanations, so in number 1, for 250,000 is to eliminate intercompany sales. So between the parent and the subsidiary. In number 2, to eliminate intercompany profit in ending inventory, where the ending inventory is 125,000, and we multiply it by 25 over 125. So 25 is the profit, the inventory balance of 125,000. So we have to eliminate. Then number 3, to recognize intercompany profit in beginning inventory realized during the period and reduce consolidated retained earnings for unrealized intercompany profit at the beginning of the year. That's 50,000 multiplied by 25 over 125. Now that's for the intercompany profit in beginning inventory realized during the period and reduce consolidated retained earnings for unrealized profit at the beginning of the year, referred to elimination entry number 2 last year. So 125,000, that's the inventory multiplied by 40%. So we now get 50,000. We add 250,000 times 1/2, or 125,000. That's how we have 175,000 under S column. So we have the beginning inventory, and then we have the current purchases. Then asterisk 2 includes 10,000 of unrealized profit in ending inventory from the previous year and not yet sold to third parties. Now, unrealized intercompany profit in the amount of 25,000. That's 125,000 times 25 over 125 resides in the ending inventory of S company. Work paper eliminating entries 1 and 2 are similar to those discussed in the preceding example. So we have now the use of the cost model. If the parent uses the cost model of recording its investment in the subsidiary, the entry takes the following form, shown in figure 4-3. So the entry is to debit beginning retained earnings of P company by 10,000 and credit to ending inventory in the income statement for cost of sales to realize profit in beginning inventory deferred in the prior period. If the parent company uses the equity method, this debit is replaced by a debit to the investment in subsidiary account. So we refer to 4-4. The credit to beginning inventory cost of sales in entry 3 is necessary in order to recognize in consolidated income the amount of profit in the beginning inventory that has been confirmed by sales to third parties during the current period. So we have now the entry for beginning inventory, beginning retained earnings of P company, and credit to ending inventory for the income statement. Now, S company charges cost of sales for its cost of 50,000, whereas the cost to the affiliated group of the beginning inventory of S company is only 40,000, or the ending inventory of first year. Accordingly, cost of sales must be decreased by 10,000, which increases consolidated net income by 10,000. The adjustment to beginning inventory this period is in the same amount with ending inventory by last period. Now, for firms using the cost model to account for its investment in the subsidiary, the rationale for the debit of 10,000 to beginning retained earnings for of P company is as follows. In the previous year, P company recorded 25,000 in profit on intercompany sales and transferred it to retained earnings account. Now the 25,000 being the difference between 125,000 and 100,000. So the 25,000 is already recorded in profit on intercompany sales. Inasmuch as the beginning of the year, 40% of that amount has not been realized by sales to third parties, it must be eliminated from the beginning inventory or beginning retained earnings of P company to correctly reflect the beginning consolidated retained earnings. In determining consolidated net income in the prior year, 10,000 was deducted from the reported income and from the retained earnings of the affiliated group by a work paper entry, which, like all work paper entries, was not posted to the ledger accounts. In order for beginning retained earnings to match the prior year's ending retained earnings to the consolidated entity, this 10,000 adjustment must be made to beginning retained earnings. Consolidated sales of 202,500 are equal to the amount of sales of the affiliated group to third parties. Consolidated cost of sales of 140,000 equals the cost to the affiliated group of the goods sold and are calculated as follows. So we have now the cost of goods sold transferred to S company in prior year and sold this year is 40% 100,000. That's the cost of sales of P company during the first year. Then we have the cost of goods transferred to S company in current year and sold this year. So 1/2 multiplied by 200,000. Cost of sales of P company second year. And so we have now the cost of sales to third parties during the current year. So initially it's the sum of the intercompany profit on purchases and sales, and we have now the cost of goods transferred to S company during the current year and sold this year. So only 1/2 of the purchases from parent company. So corresponding adjustment should be made if there will be a change in the data of the problem. Like, for example, in the current year, you already have your accounts in connection with uh, third parties and even with the affiliated groups. Now, it should be noted that the cost model is allowed under PS 27. So, any discussion about the cost model, any discussion on equity method for this chapter and in chapter 5 is for purposes of comparison and at the same time appreciation of the significance of the equity method. So the significance of the equity method. So we have now the equity method. For firms using the equity method, the debit to beginning retained earnings is not needed, assuming the parent correctly adjusted for all intercompany profits and losses in its subsidiary investment income or income from subsidiary account in the preceding year. Under the equity method, consolidated retained earnings are identical to the parent's reported retained earnings and thus no adjustment is needed. The eliminating entry for the realized profit in beginning inventory should be as follows. So we have now the entry to debit investment in subsidiary and credit ending inventory income statement for cost of sales to realized profit in beginning inventory deferred in the prior period or in the first year. So we have the income as realized by the parent company. Then the debit to retained earnings is replaced by a debit to investment in subsidiary, which serves simply to facilitate the elimination of this account on the work paper, as shown in Figure 4-4. In Figure 4-4, under the equity method, the partial consolidated statements work paper elimination of downstream intercompany sale of inventory, unrealized profit in ending inventory, second year of intercompany sales. So we are still on downstream sales of 250,000. This is now on the second year, and we have the sales to third parties to appear in the consolidated balances, and we have now the amount of cost of sales of 140,000, and so we have the gross profit of 162,500. So likewise, we have here 175,000, and the inventory should be adjusted for 125,000. So we now debit sales and credit to cost of sales. Okay, so this is how we prepare the elimination entries. We are now on the second year. So for the consolidated balances, we have for sales, for cost of sales, and finally the difference of 60 to 500. Now for the consolidated profit, the inventory end now is 100,000. And for the investment in subsidiary, due to unrealized income last year, we have the amount of 10,000 to be reflected in your elimination entries this year. Now, to eliminate intercompany sales, that's in entry number 1. In number 2, to eliminate intercompany profit in ending inventory. So we have the amount of 25,000. So we now debit to cost of sales and credit to ending inventory. Then number 3, to recognize intercompany profit in beginning inventory realized during the period and reduce consolidated retained earnings for unrealized intercompany profit at the beginning of the year, or 50,000 multiplied by 25 over 125. So we refer to eliminating entry number 2 last year. Here we have 125,000 multiplied by 40%, or 50,000, and we add 250,000 times 1/2, or 125,000. So the total of 175,000. Determination of amount of intercompany profit. In the preceding examples, the amount of intercompany profit subject to elimination was calculated on the basis of the selling affiliate's gross profit rate, stated as a percentage of cost. Recall that the gross profit may be stated either as a percentage of sales or as a percentage of cost. When it's stated as percentage of cost, it's often referred to as markup. To calculate the amount of intercompany gross profit to be eliminated from ending inventory, be careful to distinguish between percentages stated in terms of sales versus cost of sales. Next, we have determination of proportion of intercompany profit to be eliminated. It's clear that unrealized intercompany profit should be included in consolidated net income or assets. However, two alternative views of the amount of intercompany profit that should be considered as unrealized exist. The elimination methods associated with these two points of view are generally referred to as we have 100% total elimination, and number 2 is partial elimination. Both current and past GAAP require 100% elimination of intercompany profit in the preparation of consolidated financial statements. Because past and current GAAP and PFRS are silent in this regard, we do not elaborate on the alternatives of partial elimination. The following items should be properly noted. Under the 100% elimination, the entire amount of unconfirmed intercompany profit is eliminated from consolidated net income and the related asset balance. This approach is particularly logical under the proposed view of consolidated financial statements based on the entity rather than parent concept as required by PFRS 10. The amount of intercompany profit or loss to be eliminated is not affected by the existence of a non-controlling interest. A complete elimination of the intercompany profit or loss is consistent with the underlying assumption that the consolidated statement presents. So the underlying assumption that consolidated balances should be prepared at the end of the period. Now, after the downstream sale of inventory, we have now the upstream sale of inventory. When an upstream sale of inventory occurs and the inventory is resold by the parent to a non-affiliate during the same period, now we have to understand that upstream sale is again from the subsidiary to the parent, and the parent now resells the inventory to a non-affiliate during the same period. The entire parent's cost model entries or even equity method and eliminating entries in the consolidated work paper are identical to those in the downstream case. The only difference between upstream and downstream profit is when the inventory is not resold to a non-affiliate before the end of the period. Work paper eliminating entries are different from the downstream case only by the apportionment of the unrealized intercompany profit to both the controlling and non-controlling interest. The intercompany profit in an upstream sale is recognized by the subsidiary and shared between the controlling and non-controlling stockholders of the subsidiary. Therefore, the elimination of the unrealized intercompany profit must be reduced by the interest of both ownership groups each period until the profit is confirmed by resale of the inventory to a non-affiliated party or outside party. Determination of the non-controlling interest in consolidated income. Intercompany sales of inventory necessitate adjustments to the calculation of the distribution of income to the controlling and non-controlling interest, whether the adjustments directly affect the non-controlling interest or only the controlling interest depends on who the intercompany seller or the seller selling affiliate is. If the intercompany seller is the subsidiary, it is the subsidiary's income that needs adjustment, thereby directly affecting the non-controlling interest. On the other hand, if the intercompany seller is the parent, it is the parent's income that needs adjustment. So we have now this upstream. Okay. So we now debit to sales, credit to purchases for cost of sales. So we have now for debit sales. Normally it's credit, and we have to credit purchases, which is a normal debit. The summary of elimination entries relating to intercompany sales of merchandise Consolidated statement work paper eliminating entries for intercompany sales of inventory are summarized in Table 4.1. The entries under the equity method or cost model to record its investment. However, the form of the work paper entry for unrealized profit in beginning inventories differs between upstream and downstream sales. Now, to eliminate intercompany sales, the selling affiliate is the parent, so it's a downstream sale. Here, the selling affiliate is the subsidiary, so it's an upstream sale. If the selling affiliate is the parent, in the case of downstream sales, to eliminate intercompany sales, we debit sales or credit to purchases or cost of sales. Same with the entry if you have now the selling affiliate as the subsidiary. Now, to recognize realized profit in beginning inventory. So to recognize realized profit in beginning inventory, again, we have to debit investment in subsidiary under the equity method or beginning retained earnings under the cost model and credit to beginning inventory in the income statement or cost of sales. So take note, you either have the equity method or the cost model. Now, if the selling affiliate is the subsidiary, meaning it's an upstream sale, so we now debit to investment in subsidiary under the equity method or debit to beginning retained earnings. And likewise, it will be confusing on the part of the parties. Here, if the selling affiliate is the subsidiary and that will involve upstream sales, so for the non-controlling interest, we now debit to non-controlling interest and credit to beginning inventory or income statement under the cost model. Okay, so we have now to eliminate. Let's take up that portion. To recognize realized profit in beginning inventory. Again, we debit to investment in subsidiary under the equity method or we debit to beginning retained earnings under the cost model, then credit to beginning inventory in the income statement. If we have the upstream sales, again we debit to investment under the equity method or we debit to beginning retained earnings. So we have now that's under the cost model. So we have beginning inventory in the income statement and non-controlling interest beginning inventory in the income statement. We have now the elimination of the unrealized profit in ending inventory, debit ending inventory in the income statement, and we credit to inventory end. That's the credit inventory end for the balance sheet. Now, we have now the consolidated financial statements with partially owned subsidiary, downstream and upstream. Illustration for 80% owned subsidiary under the cost model, partial goodwill approach. or elimination of downstream and upstream intercompany sale of inventory, unrealized profit in ending inventory. To illustrate all aspects of intercompany, here we have to illustrate all aspects of the intercompany transactions, the downstream and upstream sale when the parent company records its investment using the cost model, assuming the following. So, we have on January 1, 2024, we are now a perfect company acquires 80% of the common stock of Sun Company for 310,000. At that time, the fair value of the 20% non-controlling interest would be, but you have to take note that some of these illustrations involve downstream and some upstream sale. To illustrate all aspects of the intercompany transactions between here downstream and upstream sales when the parent company records its investment using the cost model, assuming the following. January 1, 2024, Perfect Company acquires 80% of the common stock of Sun Company for 310,000. At that time, the fair value of the Sun's investment. So we have here, using the cost model, we assume the following. On January 1, 2024, Perfect Company acquires 80% of the common stock of Sun Company for 310,000. At that time, the fair value of the 20% non-controlling interest estimated to be 77,500. On that date, the following assets and liabilities of Sun Company had book values that were different from their respective market values. So we now have the amount of investment of 310,000, debit to inventory, debit to land. We have debit to equipment. So these are now your accounts. That's the amount of land 20, inventory 20, land is 40, but it's very difficult to comprehend what's not around you. Book values also shaded, no? On January 1, 2024, Perfect acquires only 80% of the common stock of Sun Company for 310,000. At that time, the fair value of the 20% non-controlling interest estimated to be 77,500. On that, the following assets and liabilities of Sun Company had book values that were different from the respective market values. So we have now the accounts of Sun Company and at book value and at fair value. So we have now the adjustment debiting to inventory. We have the debits for the perfect for inventory, Sun at book value and at fair value, land, equipment, though equipment the same balances, But we have the accumulated depreciation. Then we have buildings, accumulated depreciation. And finally, the bonds payable, good for 4 years. All other assets and liabilities had book values approximately equal to their respective fair values. On January 1, 2024, the equipment and buildings had a remaining life of 8 and 4 years. So we have now the however, inventory is sold in 20x4 and 5 for inventory costing method is used. Goodwill, if any, is reduced by 3,125 impairment loss. So, 325 impairment loss and uh, during 20x4 and the amount of 3,124 impairment loss occurred during 20x4 based on the fair value basis for full goodwill, meaning the management determined that the goodwill arising in this acquisition of the Sun Company relates proportionately to the controlling and non-controlling interest as a domestic impairment, or we have thus the impairment. Okay, so we have now the accounts as they appear in the intercompany sales information. Take note that I have added here. Inventory is sold in 20x4 and 5 for inventory costing issues. Goodwill finished reduced by 3,125 impairment loss during 20x4 based on their value basis or a fair value basis or full goodwill, meaning the management has determined that the goodwill arising in the acquisition of the Sun Company and non-controlling interest as thus the impairment. There were no intercompany sales prior to 20x4 and meaning the management is determined that the goodwill arising in the acquisition relates to proportionately the amount of proportionately to the controlling and non-controlling interest as does the impairment. Now, there were no intercompany sales prior to 20x4. Information resulting from intercompany sales or ending inventory and gross profit rates are summarized below. So we have now the first year, 20x4, x5, 20x6, and we have now the years X4 and X5 and the intercompany merchandise in December 31, intercompany inventory of S company, and we have the intercompany based on profit. So we have now 20% intercompany profit based on selling price. So we have X5 and other computations. Now for upstream, the one at the bottom is already upstream sales for X4 and X5. So we have now the sales of subsidiary to a parent of 62 500, and the intercompany merchandise 12 in 20, here 50% of sales, and the intercompany profit is 40%. In 20x5, sales amounted to 42,500, and we have the intercompany sales of merchandise. And the last column, inter company profit based on selling price. Now we have the trial balances for the companies for the year ended December 31. Here we have the debits, and included in the credits are the terms accumulated depreciation for that, no, for example. So we have now the trial balances with the corresponding assets, contra asset accounts like accumulated depreciation, and then we have accounts including depreciation, and we have goodwill impairment loss and dividends. So take note that for perfect, we have the total of 1,974,000. That's the total of the assets and of the parent, and some companies only 1,020,000. Now, take note, we have the credits, accumulated depreciation, accounts payable, bonds payable, common stock, retained earnings. Then we have sales and dividend income. Now, from the trial balances presented above, the following summary. For the trial balances presented above, the following summary for 20x for results of operations. So we have now sales of Perfect and Sun, cost of goods sold, gross profit, depreciation, other expense, net income from its own separate operations, and we are now adding dividend income for 164,000, net income from the operations of Perfect, and only 50,000 from the operations of Sun. The resulting ownership situation can be viewed in the schedule of determination and allocation of excess. The over-under valuation of assets and liabilities is summarized as follows. So we have now the columns Sun. Okay, so we have now the inventories, land, equipment, buildings, and bonds payable. And since the problem is asking for these figures, assuming that we have now the resulting ownership situation, this can be viewed in the schedule determination and allocation of excess. So take note that Perfect Company may take up the accounts separately, and the same with Sun Company. Now we have the schedule of determination and allocation of excess under partial goodwill. Date of acquisition is January 1, 20x4. The fair value, that's the consideration transferred, 310,000. Then we have to deduct the book value of stockholders' equity of Sun. So the consideration transferred in case 1 is only 310,000. Then we deduct. Okay. So we have now the common stock of 160 retained earnings. Okay. So we have now the book value of stockholders' equity of Sun. Sun is the subsidiary. So we have now the common stock of Sun, 200,000, but we multiply this by the parents' ownership interest, then retained earnings. For the total to be deducted of 240,000. So the difference now is the allocated excess. The excess of cost over book value of 70,000. Then we have the allocated excess of 70,000. We are going to add over undervaluation of an asset and liabilities. First, we have increase in inventory, 5,000 multiplied by 4%. Increase in land, decrease in land, increase in land, increase in equipment, and we have decrease in buildings. Okay, so we have now the positive excess, the fair value model, or again, we have the positive excess shown in the computations in the amount of 10,000. Okay, the over-under valuation of assets and liabilities is given as follows. So we have Sun Company, book value, and fair value. And so we have the over or the under valuation. We have for the under or over valuation for the inventory, land, equipment, building, and we have fine or as the total of the bonds payable is now given are the net amounts for Sun's book value and the fair value. As given, there is an undervaluation for inventory, land, and equipment, but for building, there is an undervaluation. So we now go to the buildings. Buildings and equipment will be further analyzed for consolidation purposes. So we have now the equipment. We deduct the accumulated depreciation. So we have now the book value and the net book value or fair value. So take note that these book values are given for Sun, including the fair value. Now, summary of depreciation and amortization adjustments is for inventory, we have 5,000. At the inventory end now becomes part of the cost of goods sold. Take note that this is inventory beginning. The life is only one because under the FIFO method, we assume that the first units purchased will be the first units to be sold. Subject to annual amortization for equipment, there is an undervaluation of 80,000 divided by 8 years. So meaning it's 10,000 per year beginning 20x4. And we have now the buildings with net overvaluation in the amount of 20,000 divided by 4, so it means 5,000 per year. And the discount on bonds payable, the amount of 1,000 that should be charged to interest expense. Now, the goodwill impairment loss of 3,125, actually in the previous problems that we already discussed, the amount of the goodwill impairment loss is 3,750. If you can recall this problem, we have already used the figures in the previous problems. Based on 100% fair value would be allocated to the controlling interest and the NCI based on the percentage of total goodwill each equity interest received. For purposes of allocating the goodwill impairment loss, the full goodwill or the fair value model is used. So the fair value of subsidiary consideration transferred 310,000. Then we have fair value of the NCI of 77,500. So we have the total. We deduct the book value of the interest of the subsidiary of 300,000. 87,500 is the excess of cost over book value. Then we have the over-under valuation in the amount of 75,000. We have goodwill, full goodwill of 12,500. So the goodwill applicable to parent is 10,000, that's 80 percent, and to the non-controlling interest equal to 20% or 2,500. Now, the goodwill impairment loss would be allocated as follows. So, this time the amount is correct to be 3,125, not the 3,750 in the previous problem. So, the goodwill impairment loss attributable to parent or controlling interest, 2,500. Then the goodwill applicable to the NCI equal to 625. That's for the non-controlling interest, no? The non-controlling interest. So if we have now the rate of 20% of 3,125. So 20% for the NCI and 80% for the parent. The unrealized profit on January 1 and on December 31, 2025, resulting intercompany sales. For downstream sales, sales of parent to subsidiary. So we have now your intercompany merchandise on December 31, inventory of S company, and so we multiply 125,000 times 60%. That's the portion sold. So we have now the amount of 75,000 times 20% or 15,000. That's the unrealized intercompany profit in the ending inventory. So the portion unsold. And we have now the sales of parent to subsidiary of 100,000 in 20x5. So we have now the intercompany merchandise on December 31, inventory of S company of 100,000 times 80% or 80,000. So 80,000 multiplied by 25%. That's the unrealized intercompany profit in ending inventory. Now we have for the upstream sales. So we have now the sales of subsidiary for the upstream sales. The sales of subsidiary to parent 20x4, the amount of 50,000, and here we are given the amount to be post recording stop first. There is something of an error. Okay, so we have to recognize in the first year of acquisition. Now I will share screen the remaining slides. There are still so many. For the remaining slides, I'm going to share screen only, but you have to study them very well because on Monday, I will get my quiz from the remaining slides. So meaning on Monday, I'll give a short quiz, and the short quiz I'm going to get from the remaining slides. Take note that the remaining slides are more in number than the slides that I have already discussed. Okay, so I'd like to repeat. I am going to share screen the remaining slides, and this will be the source of my short quiz on Monday. So taken from chapter 4. The remaining slides, there are a lot of this. So I hope you will study, especially the slides that were not discussed, are not discussed. Okay, so we have now the entry in recording investments and as well as the elimination entries. Now you will notice that these entries are very familiar to you because we have been discussing them since chapter 1. So we have now the elimination entries. If you can recall, we have the elimination entries in the problems in chapter 3. Only that now we have more elimination entries. So you study all these entries up to the last slide. Now this time you have the debits and the credits based on the elimination entries. Then after which we have the consolidated statements. We have the consolidated statements. So take note again that we have the adjustments and elimination entries. After this, we have the consolidated balances. Now you take note of the corresponding pairs taken from your entries here. So we have E4, E5, E6. So take note that following are your elimination entries. Okay, so we have again the Ayan. Ay, ang balik ni man. Door. Diyan. Diyan, balik ko yun. May gilakat to. 100. 100.